Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kesslering, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Welcome, ladies and gentlemen, to the Absolute Return Podcast. I'm your host, Julian Klimachko. I'm joined by my co-host, Mike Kesslering. And on today's podcast, we welcome special guests, Todd Degelman and Chad Pruden of Wellington-Altus Private Wealth, where Todd is founder, senior investment advisor, and vice chairman, and Chad is senior investment advisor. Wellington-Altus is one of the fastest growing wealth advisory firms in Canada. On the show, Todd and Chad discuss their career backgrounds and keys to success in wealth management, their outlook for equity markets, bonds, and inflation, asset allocation and what is top of mind for high net worth investors, what differentiates Wellington-Altus from the big banks, and more. So with no further ado, here's our discussion with Todd and Chad of Wellington-Altus. I'm excited to have Todd and Chad from Wellington-Altus Private Wealth on the show today to chat about everything markets, asset allocation, investment advisory, all the fun stuff, all the stuff that is top of mind for investors these days. So thanks, guys, for coming on the show. I want to start off with just a quick overview on each of your backgrounds, specifically your career trajectory, your current role at Wellington-Altus Private Wealth, and just to give our listeners and audience a quick rundown of just, where you've been and where you're at currently. So, Todd, do you want to start out?
Sure. My background, I started the business in 1994. I was trained and worked at Scotia McLeod for about 7 years. Then I met a guy named Charlie Spiring who just started at Wellington West back then, and jumped on board with him to not only bring my practice over, but to help build that company with him. Spent 6-7 years on the road, taking that company from $700 million to $10.3 billion. We ended up selling it to National Bank. Spent 6 years with handcuffs on to stay with them after the sale, and found out quite quickly that the only thing worse than being at a bank-owned firm was getting the chance to be an independent and coming back to the bank-owned firm. And so quite quickly we realized it was time to open up our company again. April 2017, I co-founded Wellington-Altus with Charlie Spiring and Sean Hauser. In 4 years, we built the company from zero to over. We're reaching right around 18 billion of assets, and on the road to 40, 50 billion here. So we're just having a great time building something pretty unique.
Okay, great. And Chad, how about yourself?
Yeah, so I started out in that bank channel as well. Started out in, I think it was like 2007. So it's just a great time to start as an investment advisor. I got a lot of life lessons real fast. So I worked in the bank channel for just shy of 10 years, and just felt the same kind of pressures. Had a lot of clientele where you're trying to be all things to all people, and I think that's a hard process to run. So was looking, traditional way to go kind of through your big bank brokerages, and heard of this goofy guy named Todd Degelman. So I thought I'd come and have an interview with him, and he kind of said all the right things, and decided to take a complete 180 and go into the independent channel, and haven't looked back since. So it's been a good journey, and I think it just evolves with how the world's moving too. So it was a good fit.
I really wanted to focus on how the being independent is dramatically different than being at one of the big Canadian banks. But prior to that, just wanted to clarify that Wellington-Altus is effectively, the second edition. The first one, Wellington West, which was obviously very successful, so sold for a ton of money to National Bank, started up Wellington-Altus a number of years ago, and, kind of not necessarily redoing the same playbook, but building something from scratch into something large, as you indicated, currently 18 billion on your way to 40 to 50 billion. So Canada is a very unique market environment in that you have this big bank consortium, this quasi oligopoly that tends to dominate investment advisory services, distribution, etc. What are some of the key features and benefits of being independent and then Wellington-Altus specifically, and how does that benefit clients?
Yeah, no, great question. There's probably about 5 questions within that question, but for the clients itself, and I think that's the number one thing when we thought about creating a different firm and an independent firm. Instead of always reporting to the shareholder, why don't we report to the client, and why don't we invert that triangle? And if we do what's right by the clients, advisors will do well, management will do well, the company will do well. So that's kind of the philosophy. Just overcare, drive the client experience to the best that we can, and if we do right by the client, the firm will take care of itself, and others will come. In terms of specific things that I think are positive to being an independent, number one, we don't sell any proprietary products. We don't go to a bank and get sold a bank mutual fund. We're on the same side of the coffee table as the client. There's no tied selling. The one thing that frustrates me so much nowadays is we actually pick up the phone. And I don't know, every time I call a bank, I can never get the guy I want to talk to.
Right.
And it's just trying to care more. We can make decisions on the spot. We don't have to go through 3 levels of management to get authorization, which holds things up and creates time delays. It's very much a team approach. I always call it the Wellington family. We celebrate everybody's wins and successes, and we try to truly help each other. And if you have that team approach, you can look at any good sports team. The teams that win the Stanley Cup or the Super Bowl are the guys that play like a team. And there's an additional level of excellence that happens when you're a team player. That's our motto. And you can only do that if you have a culture that truly cares about the guy in the desk next door to you and happy for his wins. Technology is leading edge. You get the benefit of starting a new platform. Obviously, you get cloud-based type of products and softwares that you might not get at the bank because they're using these old freight liners, I used to say. And we're a little speedboat that are very agile. It can move around these freight liners really quickly. And in the end, we get to pick who we want to work with. So a guy like Chad, he's obviously an all-star, a great talent. I want to find talented people. I want to find talented people out there that are entrepreneurial minded. And if you have that, you're going in the right direction.
And now a word from our sponsor, Accelerate, one of Canada's most innovative and fastest growing alternative investment solution providers, with a suite of institutional caliber alternative ETFs for investors seeking diversification and long-term performance. The Accelerate One Choice Alternative Portfolio ETF, symbol 1C, ONEC on the TSX, is Canada's first alternatives portfolio solution, providing exposure to 6 alternative asset classes, 10 alternative strategies in one easy-to-use, one choice ETF that charges a management fee of just 0.2%. The Accelerate One Choice Alternative Portfolio ETF trades under the symbol 1C, ONEC on the Toronto Stock Exchange. Find out more at accelerateshares.com.
Then moving a little bit to where we are at in terms of the current market environment, the equities really have been on a tear since March of 2020, kind of in the depths of the COVID pandemic. They've been, very much a V-shaped recovery. Now a little bit of equities rolling over now in September of 2021 and into October. What's your outlook for the equity markets moving forward?
Run. No, I'm just joking. I think that's such a tough question. I really believe that you should build a risk portfolio. So instead of focusing on equities go up and down, I think you should get the asset allocation right. And that's very boring, and you probably just lost half your listeners now. But but I think it's been lost. I think you're right. We've been in this straight one regime style for so long. Like we've been in this one quadrant of high growth, low inflation for a long time. And I think a lot of portfolios are set up that way. I think a lot of portfolios are still set up with 2 asset classes, stocks and bonds. And the problem is they continue to do well, and the hardest time to make a change in something is when it's doing well. I think we're going to have to be careful. I think with valuations kind of creeping in, but going back to, do we have a shift in the quadrant? Do we move from as I said, a high growth, low inflation to, heaven forbid, a stagflation type of scenario where we have high inflation, low growth, which is, a really, really tricky one to get through. And we'll see how, the Federal Reserve handles that. If you look, is he going to push, inflation, or is he going to push unemployment, right? Is he going to push job growth? And it sounds like he wants to push job growth, and sounds like he thinks inflation is transitory and it's not here to stay. But I think you should always be cautious. I think you should always know your pain threshold. So it doesn't necessarily, to be honest with you, I don't know. I think if you sit down with someone and they tell you where the stock market's going to go, you should probably run pretty fast, because I think ultimately nobody knows. And so it's been a boring approach to have an asset allocation. Asset allocation hasn't been rewarded for so many years. And I think it's going to come to fruition now too. Like if we start to see some downs and the downs actually stay. Like, you go through COVID and you only had 2-3 weeks of pain and it's over, right? So I think we need to take a look at that. I think rates continue to be probably something you should focus on as well.
I'd be willing to bet that listeners of the Absolute Return podcast love hearing about asset allocation. But I digress. You touched on some good points with respect to interest rates, a 2-asset portfolio, and kind of the dangers of not necessarily being diversified. I did want to touch on the fixed income side of that equation, because bonds, despite the 10-year being at 1.5%, very low yield, significantly lower than inflation currently, which is obviously problematic. I was just wondering, how do you feel about fixed income in the current market environment?
So this is, I would say, and Todd can chime in on this if he wants to, but to me, this is my biggest worry. With the clientele that we deal with, if you're a retiring individual and you need to make X in rate of return, it's like, how much more juice can I get from this?
Yeah.
And so this is probably, we've had lots of people on the podcast singing this story and it's been a hard call to get the rate call right. But, I just think it has massive, massive implications go forward. You kind of alluded to it. When inflation is higher than what you're making, your net after-tax rate of return is negative. And does it, do bonds act as a ballast anymore? In 2018, you got a quick taste of what that was like when the market went down and, your 2 asset class diversification portfolio all went down. And so I think what happens is if you have low rates, what you have to do is you get pushed to areas that you don't necessarily want to be. And so do you get pushed to high yield? And, even at, I'm not sure the current yield, but let's say the current yield on a high yield bond index is 5%, like in your 5% rate of return you need to make, you're still not quite almost getting to your goal after tax. But you've now masked a portion of your portfolio that was supposed to be a ballast against for equities that now is becoming volatile like equities. So I think, the defined contribution pension plan, is it going to be really, really tough? We just met a client the other day and, 40% of their capital of, a $6 million account is in a bond index fund. And does that give you any type of rate of return? So to me, you could spend podcasts on this topic. It's been to me, it's the biggest risk go for it. I think equities are going to do their thing, but it'll be the interest rate decision of how you have a sleep at night when portfolios go up and down.
Yeah, especially over the past 40 years, you've had the benefit in your bond portfolio of interest rates falling. And now year to date, 10 years gone from below 100 basis points to now above 150 basis points. So bonds have done poorly year to date. You're still seeing inflows into bond funds, but it seems, and many pros think that perhaps the great 40-year bond bull market is over and we could be in for a rising rate environment. So wondering what your thoughts are, because effectively, when you're thinking about fixed income, you're implicitly making some sort of interest rate forecast. We have seen it trending up year to date, and the inflation measures would give you the signal that perhaps that could continue. Do you have an outlook for interest rates in the longer term? And, where do you think they would settle, say, in the next few years?
So I think that, again, goes back to the equity question, extremely tough to forecast. If I had our chief economist on the call here, he would say, lower for longer.
Right.
I don't think it's something that where you can take, we can take the bond purchasing away maybe a little bit, and we'll see how that goes. But I don't know if you can crank rates up really, really fast. So I honestly don't know the number, but I would say lower for longer. And I don't think a negative rate, a low rate environment has been shown to work. If you look to Europe and things like that, would have tried a negative interest rate isn't going to work. So I do think you need to look at your diversification. If you get into asset allocation, which is like, my true baby of my real passion of, I think you need to get right. It's, do you have to shift away from a 2-position portfolio?
Yeah, it's a really good point on asset allocation. I do want to get into how you think about that, your asset allocation framework. But prior to that, one other market dynamic that I wanted your thoughts on was inflation, obviously coming in significantly higher than expectations. There's this discussion of whether it's transitory or not. Certainly the nature of it is probably likely lasting longer than the central bankers have indicated. I was wondering, do you think that it makes sense for investors to have some inflation protection in their portfolios?
I don't put inflation protection in. I think inflation protection is just really common shares and buying good quality businesses. And I think that's the best inflation protection. On fixed income, we're starting to use more unique strategies as alternatives to some of the fixed income we normally put in accounts. But I haven't used any inflationary specific products for my portfolios to date.
I think inflation is a sticky one too. If you look at, we're seeing rising energy prices, supply chain disruption throughout the world. The one that's kind of I've been keeping my eye on is rent. Rent rates through 2000, you couldn't see rental rate increases, and now you start to see that catch up really fast, like double-digit growth in rents. So I think that's tricky. And then I think you have, this wage debacle going on too, like where you can't find people to come work, and so do you have wage inflation, which I think could really start the question to get it rolling. Someone working at Uber or DoorDash or Skip the Dishes can make $30 an hour. Nobody wants to go do the blue collar jobs that make $15-16 an hour. So there's a pretty big gap of where I think things have to come up to. And if you look at wage growth at 3 to 4%, that works in the current regime of this low inflation, but it sure as heck does not work in a high inflationary environment. So again, chief economist does believe inflation is transitory, but inflation is tricky because inflation is like a rubber band wrapped around a brick, and you pull and pull and pull and the brick doesn't move, and then all of a sudden it snaps and it goes. So I like Todd's point. I think, are you running a prediction portfolio?
Right.
And that's a great thing is like, we don't run prediction portfolios. I think it's incredibly hard to predict. We run risk portfolios. And so if that's a risk that we want to be cautious of, I think we can make tilts in the portfolio. And it's been a tricky call. If you've made a bet into gold as of, last little bit, you kind of got your clock cleaned a little bit too, because it's been a pretty volatile asset class. And are you getting the risk premium that you are from gold when you could go into another equity or another asset class?
Yeah, and I think that's a good lesson for investors is prediction is basically impossible when you're trying to predict inflation, rates, equity risk premium, any exogenous macro events that are really unforeseeable, whether it's a global pandemic or a great financial crisis. Really, no one had foreseen those, or the ones that do are basically calling for some sort of bear market every year and are consistently wrong. So it makes sense to have that risk portfolio, as you indicated, or an asset allocation framework. Can you talk about?
And I think, just on that point, Julian, I think it's a great topic because that's the tricky thing when it comes to investing. That's the tricky thing if you have a client listening to this podcast or one of our clients. It's like, how do you do the due diligence? Like if you're a predicting portfolio, was it something that was researched and got right, or was it luck? Right? Like in investing, is the tricky thing with investing is you can have like the absolutely worst designed portfolio, and the market can take a slight V and reward that risk.
Yeah.
And is that good? if you're an engineer and you build a bridge and the bridge collapses, you know who to go after.
Right.
Here, it's tricky because you don't know the underlying risk. And did the risk get paid off? And so that's the tricky thing right now is investing is bad decisions can be rewarded all the time and good ones not. And it's hard to stick to the course when someone else's bad decision is getting rewarded and my good decision isn't. And it's hard to stick to course because we live in like this fire hose of information nowadays. And you turn your head one way and, Facebook and Instagram were out for 6 hours yesterday. So I wonder how many people lost information and had to make their own judgment calls. So I think it's tricky as the advisor or the client now is what to believe. And that is a very, very hard point.
And hopefully investors aren't getting their advice from Instagram these days or TikTok or any of those channels, but they seem to be popular with the younger type investor. Some interesting things that I like talking about is the notion of, say you were the perfect predictor of overarching macro themes, for example, inflation or, some sort of pandemic. The ability to select the right security and know exactly how it's going to play out, that's extremely difficult. It's like, if someone told you inflation was going to print north of 5%, would you expect the 10-year yield to be like 1.53%? It's like, no one would think that, but that's what's happening.
That's a great point. And there's a great article, and I can share it with you. I don't know if you have show notes or what, but I can't remember who did it, but over the past 90 years, up until like 2019, don't quote me on the numbers exactly, but I think 86% of the stocks in the S&P 500 accounted for 16 trillion in wealth creation.
Right.
96% of stocks underperformed T-bills, again, up to 2019. So the question is, are you smart enough to pick the 4%? And if you look at the names that have caused it, there's been a handful of names. So I think just to tack onto your point, I just think that's such a great statistic is we always want to try and have the winner, but you have to get it right twice. You got to buy it and sell it. And you have emotion on both ends of it. And that's what investors are going to face right now. So your outlook for equity markets, you should just probably buy. But you'll always have a grit your teeth moment. You'll never not have a grit your teeth moment. Market can be down. Oh my gosh, it's going lower. Market's high. Oh, it's only going to go down. And so that's where I think you got to get the risk right. And that's it's boring and complexity complexity sells, and that's where it gets tricky.
And now, a word from our sponsor, Accelerate, one of Canada's most innovative and fastest growing alternative investment solution providers, with a suite of institutional caliber alternative ETFs for investors seeking diversification and long-term performance. The Accelerate Arbitrage Fund, symbol ARB on the TSX, is the world's first SPAC-focused ETF with a diversified portfolio of SPAC and merger arbitrage opportunities in an easy-to-use, low-cost ETF. The Accelerate Arbitrage Fund ETF trades under the symbol ARB on the Toronto Stock Exchange. Find out more at accelerateshares.com.
So who have you modeled some of your framework and your investment philosophy after?
Yeah, who do we model it after?
Any influences?
Or is it just purely your own creation?
Yeah, it is our creation. And when we set up Wellington-Altus the second time, and obviously a big part of my role is building the company, but Chad and I still run a very large book of business. And when I was thinking about going back and doing this again, I had the privilege that probably very few advisors ever get. And I probably interviewed more investment advisors across Canada than anybody else in Canada. I challenge anybody if they met more advisors than I have in the last 20 years, trying to get them to come to my company from Halifax to Victoria. And what you get is a lot of cups of coffee, and what you get is a lot of best ideas. And there's a lot of terrible ideas in there, but there's a lot of great ideas when you're sharing some time together. And what I try to do is take 3 or 4 of the best ideas that I had, put it together with Chad in a deck that we felt comfortable doing. And then before we started selling this idea to our clients, we entertained about 3 or 4 different accounting firms and presented it to them and said, okay, we'll blow holes in it, break it up. You guys see this stuff all the time. Well, where are we at? And what happened was we ended up getting 4 or 5 or 6 partners of major accounting firms becoming our clients, and we knew we had something. And from that point on, that's the deck we use, that's the presentation we use, and we've had great success with it
I think just to highlight on that point too, great point is, you learn, Todd's been in the industry longer than I have, and he's learned more, but I came in at a tough time. So I learned some hard lessons. So I've always been, again, that's where that risk management approach comes from. Our primary clientele is someone who's looking to make the transition from an accumulation phase to a deaccumulation phase. And that's a whole podcast in itself, this deaccumulation topic. But, we run deaccumulation portfolios for a lot of our clientele because we got to start giving it back to them, which ultimately returns back to your very first question on the outlook for equities and volatility. And I think volatility and risk get mismatched all the time. Risk is the permanent loss of capital. Volatility is the up and down in price. So, that's been great for Todd and I to, for me, especially when we kind of merged our two books together, was he really brought that piece to the game as he's seen so much. And, you could bring an idea to him and he can vet it pretty darn quick because he's seen a lot of it. So, that goes back to Todd's team approach. I think you need to be a team. You need to look for really good talent. That's why we look to you guys when it comes to setting up the portfolios, because there's a lot of people a lot smarter than me. And, Todd and I are quarterbacks. So, we'll set it up and vet it. But I don't know, gone are the days, I think, of slinging individual stocks.
Yeah, we do come across that pretty often, to be honest, but that's more of the old school way, the old school broker way where you're sort of, a gunslinger with respect to the individual securities. So you see this, massive divergence in styles and, how an investment advisor is supposed to operate. Now, for those, I wanted to pick your brain on something. For those, say they're new to the advisory business, what would you say are some keys to success to become a successful investment advisor?
I'll let Toddy jump onto this one first and I'll end it.
We were lucky enough to be named top 5 advisor in Canada three years in a row by Wealth Professional. They ask this question all the time. And, I think the first one is, as long as I've been an advisor, do what's right for the client and success will follow. It's probably the most important one. A lot of times you get too humpy on trying to bring in assets or do commission or do this or that, or trying to be too complicated. My always thought was just really try to do what's right for the client. The rest will follow. Keep it simple, make it personal, and have fun is probably the second one. And that's on our microsite. Those are our 3 words, and that's what I live by. Number 2, care more than your competition. Your clients see it. When you're in a meeting, your clients will just get it. They're not going to understand all the jargon and philosophy and strategy everybody likes to throw out there. Just show that you really care and care more than anybody else. That's a gut feel, and clients go with their gut. And number 3, Chad mentioned already, is create an all-star team. Like when you build a company like Wellington, all I'm looking for is talent. And on my team, all I'm looking for is talent. So create an all-star team, then try to make it even better. And those are my 3 rules to success as an advisor.
Great. I'll coming, into the industry to be a successful advisor. I think it actually even applies to like everything in life is you need to execute. I think you guys should get that tattooed on their forearm or something like that and never forget it, because like we all have the game plan. Like we all have it. I can show you the financial plan. I can put you through it. You need to execute on it. You need to save this much money. This is the rate of return you need to achieve. You need to execute on that. You want to lose 15 pounds, 20 pounds. You need to execute. You have the plan, right? So I think we get bombarded again by information and so many self-help books, and they all start to say the same thing. And at the end of the day, if you're a young advisor, I'm staring out my window right now at 2 young guys who have just came aboard, and these guys are going for it, right? They are pounding the phones. They're getting out there doing it. But what are they doing? They're executing on a daily basis. And my favorite quote is, commitment is doing the thing you said you were going to do long after the mood you set it in has left you. And I think if you can do that, we get really jacked up, and motivation will, when your motivation goes away, do you have consistency? And that's probably what's made Todd one of the most successful guys that I know. Is he's the most motivated bleep person, I know. The guy continues to go. He travels Canada. He runs a huge book. He's just motivated to the nines. And that's what kind of when I wanted to partner with somebody, that's what I looked for, is you got to have someone who's motivated to go. And I think you're probably seeing it with you guys, you know, you guys are motivated to win. Julian's been great. And you just got to keep pounding through it.
So another example of that motivation would be that the two of you host a YouTube channel called Todd Talks with Chad.
Yeah,
and I
really successful.
Absence of Todd.
I definitely encourage our listeners to check it out, as you do have a wide variety of interviews on there. For example, the favorite one that I came across was Marshall Falk, which is awesome to see from an advisor group in Saskatchewan. What has been your biggest takeaway from pursuing that project?
I'll jump in on that one real quick. To me, it's just varying opinion. I love it. Like I think our very first one was Michelle Romano.
Yeah, with Dragon's Den.
And our audio wasn't the best because we were kind of just slinging into it at the start. But, you know, she had this great advice of, you know, how do you make a lot of money? Concentration. How do you lose a lot of money? Concentration. And there's a lady who, you know, started in the caviar business and swung the bat and missed, right? But, you know, stayed on it. And now she's, you know, extremely successful. And if you can ever listen to her speak, she's phenomenal. Then you go to the Marshall Falk podcast where he talks about, you know, where he came from. I love that. And then the Caleb Dahlgren podcast, which I thought was great to go through adversity. So that's what I love about the podcast is that, you know, everyone's going through something. Everyone needs some help. And I think there's always tidbits of information throughout those podcasts. When we do it, it's not all just finance. That's why there are different people on it. But, you know, I think it's what you can apply from other people's, you know, lives and try to apply it to your own. And that's what I love about the podcast. And, you know, we're making massive revenue off that. Like we probably like our 22 subscribers, like they're diligent followers. So like I went for groceries the other day and I got mobbed.
Yeah. Hopefully we can double that for you from our audience here. But before I let you guys go, fun question. If you could only hold one asset for the next 10 years, what would it be and why?
Bitcoin. Okay. So, no, I'm sure.
NFT.
Okay. So this is a good question. I'll give you like, again, a boring answer. I should probably pick some kind of name, but I read the book 100 Bagger.
Yep.
And have you read 100 Bagger?
Yeah.
Well, 100 Bagger, it's like, I just love this book. I love this philosophy. So it's more not what I would buy. I would tell you where to hold it and never look at it and have this coffee can approach. So, you know, you look at companies like Netflix that have been 100 Bagger, and we all want this 100 Bagger real quick, but it's over time. You know, Netflix on its way to 100 Bagger had days where it was down multiple days, down 20% in a single day. And the problem with investing is you get picked at all the time, right? You constantly get picked at, you know what you're worth. So I won't give you an individual name, so boring, I know, but I would tell you to find good companies that you believe in and hold them, set them in the coffee can and don't look at them. Incredibly hard to do, but that would be my advice of an asset to own. I think it needs to be stocks. And then I would mix in a little bit of 1C, just a little bit of a plug there.
Nice. Todd, what's your call?
You know, I would for sure, if I was to pick one area, I guess I'd be in the tech space. It'd be something on the NASDAQ exchange. But quite truly, you know, I always preach to clients and brokers, you know, what do you know? What do you really know? And buy what you know. And I know this business. So, you know, I'm biased, but I'll be long Wellington-Altus shares all day long. And I get a chance to be a part of something great. I know the business, and you get a lot more comfortable when you know what you're doing in that field. You know, I always laugh at the farmer that comes in and really analyzes risk in his portfolio. And I said, hey, you put $3 million into dirt and hope it comes up, and you're talking about risk. And I go, it's just different. You're totally comfortable with that. That scares the crap out of me. So it's relative to each individual person. So for me, that's it.
Yeah, it makes a lot of sense in terms of understanding the risk and be able to bear it. Some people say, well, if you held Amazon since the IPO, you would have made 1,000 times your money, but who would have actually hung on to the 95% drawdown that it's gone through?
Yeah.
Like that's
totally. And then that's what I say to advisors when I'm on the road. It's like, okay, what do you know best? You're giving people investment advice for a living. You know your business. You know this company. You know the banks make money. Why not own your own company? Why not own shares in yourself and like-minded people like yourself? And that should be the draw to consider a home like Wellington-Altus.
Yeah, that makes a lot of sense. So say, a high net worth individual is looking for an investment advisor. Where can they find out more about you guys?
Well, obviously, Todd talks with Chad, but
tough to get on.
Yeah, always on our website, Degelman Pruden Group. Go on there. All our contact information on there. You can attach our emails to the podcast. We never really got into that part, but I think that's a very interesting space in the market right now. Is the high net worth space. It's like, what do you do when you have enough, right? What avenue do you go? Do you lock it down in safety, or do you go bigger? And to me, this is an investing podcast, but taxation will be the big thing. I think it's not what you make, it's what you keep.
Right.
And my big passion is taxation is they're going to probably come for the top 1%. Mm-hmm. And so what do you do? What strategies are being implemented? And it's crazy, but we'll sit down with a guy who has, $20 million and his investment advisor and his accountant have never met, never spoke, don't know. Right. And so that's been a big thing, I think, to Todd and I's success is, creating this virtual family office of where a client comes in and, we are the Amazon. We have everything, one-stop shop. Everyone actually talks to somebody. And so in a world of lost form of communication, I think it's of the utmost importance, especially as the net worth starts to creep up. So
that makes a lot of sense. So Todd and Chad, I'd like to thank you for coming on the podcast today. And to our listeners, one thing that I'm coming away with is a quote, care more than your competition. And that's meaningful to basically any business. It's always competitive. You got to differentiate yourself, work harder, and just care more. And I think that's a great insight that our listeners can carry on. So if you guys are interested, check out the website. We'll post your email and contact information as well. So thanks, gents, for coming on the show.
Thanks for having us.
Thanks, Julian. Thanks, Michael. It was awesome, guys. Really appreciate the opportunity.
All right. Thanks so much. Bye, everybody.
Take care.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.